Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know. First, a Wall Street expert warns record US home bias creates risk, while India's 118% 5-year market surge signals the next global growth story. So we'll discuss why this extreme investor concentration is a classic contrarian signal and what it means for capital flows into emerging markets. Second, Denmark loses a £1.4 billion fraud case after a UK court blames its non-existent controls, threatening Europe's €150 billion Cum-Ex recovery efforts. We'll examine how this ruling could trigger a dumb government discount, raising borrowing costs for other European nations with weak institutional controls. Third, Douyin's 46% sales surge forces Western brands to reinvent their China strategy, yet luxury giants like LVMH still see sales plunge 16%. In this episode, we'll break down the rise of interest e-commerce and the powerful guoxiao trend and what it signals for global brand strategy. While US markets are hitting record highs, a top Wall Street expert is sounding the alarm. According to Dave Nadig of ETF.com, home bias is about as bad as it's ever been in the United States, warning that the average investor has far too much money in domestic stocks. This overconcentration in what's known as home bias creates risk, but it can also function as a classic contrarian signal. You know, historically, when this preference for domestic stocks gets so extreme, it's often been followed by a period where international stocks outperform US stocks. US households currently hold about 80% of their stock investments in domestic companies, even though the US market only makes up about 55% of the entire global market. And recent numbers suggest this shift might be underway. While the Dow, S&P, 500 and NASDAQ all climbed, the iShares MSCI Emerging Markets ETF quietly gained almost 3%, closing at a 52-week high. But that's not the whole picture. Even this impressive gain can be a bit misleading. Actually, a significant portion of this fund's recent performance has been driven by the rebound of just a few mega cap Chinese tech stocks like Tencent and Alibaba. So the thing is, investors might be unknowingly taking on concentrated risk tied to China-specific policies rather than getting the diversified emerging market growth they think they're buying. This is precisely why some savvy investors are now looking beyond these broad funds. If that was just the appetizer, the main course is just being served. One fund, the Emerging Markets Internet ETF, is up a jaw-dropping 35% so far this year. So where is this explosive growth coming from? All eyes are turning to one country, India. This year, India surpassed Japan to become the world's 4th largest economy, and the IMF projects its GDP will grow by 6.2% in 2025. To add some concrete evidence, private sector capital expenditure is projected to surge by a massive 66% compared to just a few years ago. This isn't just a number, it's the foundation for future economic expansion. And while its main index, the NSE Nifty 50, has underperformed the US this year, its 5-year track record is a blistering 118% surge. According to Kevin Carter, founder of EMQQ Global, the reason is simple. India now has the largest population, the best demographics, and the fastest growth in the world, all driving massive consumption. His final point is the one making investors scramble. What's happening in India right now is the same thing we saw in China over the last 20 years. Now, the next China analogy is powerful, but India's path is unique. China's boom was largely fueled by state-led investment and an export machine. India's growth, by contrast, is being driven more by its own domestic consumption. What's really at play here is a change in global capital flows. We're seeing a trend where long-term stable investment, known as foreign direct investment or FDI, is increasingly favouring so-called friendshored economies like India. This geopolitical shift is becoming a primary factor for long-term investors, potentially even more important than traditional valuation metrics. So the ongoing focal point to watch is not just India's growth numbers, but the type and quality of capital flowing into the country. We were just talking about where global capital is flowing for growth. Now, let's shift our focus to a story about where government money is disappearing due to massive fraud. A European government just lost a staggering £1.4 billion fraud case in a UK court, And the reason why is almost unbelievable. The situation presents a fascinating duality. On one side, a Danish tax case, but on the other, a fundamental legal roadblock being heard in a UK court. This is all because of a long-standing doctrine called the revenue rule, which says one country's courts won't enforce the tax laws of another. Without a specific treaty, Denmark couldn't just ask the UK to collect its taxes. It had to file a civil lawsuit and prove it was a victim of fraud under UK law, a much higher bar to clear. Denmark's tax authority, SCAT, went after hedge fund trader Sanjay Shah, alleging he orchestrated a massive Cum-Ex scheme. The twist? Shah is already in a Danish prison for the very same scheme. Yet, in London, the civil case collapsed. The judge ruled that the Danish tax authority was not misled, stating that its own controls were so flimsy as to be almost non-existent. This is a textbook example of what experts call a failure of state capacity. It's not about policy, it's about a government's basic ability to function, to collect taxes and manage its own systems. We're not just talking about lost tax revenue, we're talking about a government spending hundreds of millions on a legal battle only to be told its own incompetence was the problem. The court found that of over 4,000 dividend refund claims examined, not a single one was valid under Danish law. The government could have rejected every single one, but it didn't. This is where the situation takes a more complex turn. This isn't just about Denmark. The Cum-Ex scandal is a Europe-wide problem, estimated to have cost at least 12 governments a jaw-dropping 150 billion euros. This ruling effectively turns those potential recoveries into zombie liabilities. If Denmark couldn't get its money back, the chances for other countries like Germany and France have just plummeted. The judge acknowledged the scheme is driven by substantial greed and called the Mastermind, Sanjay Shah, not a trustworthy individual. But that wasn't enough. The evidence showed SCAT's failure was so total, it couldn't legally claim it was deceived. What really brought this to a head was the potential aftermath, what some analysts are now calling a dumb government discount. Believe it or not, investors are now watching very closely. When a supposedly safe country like Denmark is exposed for such fundamental administrative failure, investors may start demanding higher interest rates on its government bonds to compensate for this new risk. In fact, following the ruling, the yield spread on Denmark's 10-year bonds widened. The key focal point to watch now will be the sovereign bond spreads of other European nations that were also victims of the Cum-Ex scheme. In one of the highest value civil cases ever heard in the UK, the court didn't just rule on a fraud claim. It delivered a damning verdict on a government's own failure to protect its treasury. From a story of institutional failure in Europe, let's shift to a market where the institutions, in this case, e-commerce platforms, are so powerful. They're forcing Western giants to completely reinvent themselves. China, let's start with a single statistic that might just change your entire perspective on this market. An expert just went on the record saying that for foreign brands, a new social media app can generate more sales in 6 months than Alibaba's Tmall did in 2 years. That platform is ByteDance's Douyin, which has pioneered what experts call interest e-commerce. Instead of searching for a product, users see content they love and a buy button appears right there. It turns entertainment into impulse purchases. The numbers are staggering. In 2024, Douyin's total sales volume soared by 46% to reach 2.7 trillion RMB. Interestingly enough, this model is now being copied by Western platforms like TikTok, making what happens on Douyin a leading indicator for future global trends. While headlines focus on China's economic slowdown, Western giants aren't pulling back. They're radically changing their entire playbook. The old strategy of rolling out global products is dead. Under Armour is now creating products for China that sell for under $14. Kraft Heinz is decorating entire subway stations to look like ketchup bottles. This isn't just about clever marketing, it's about data. Chinese e-commerce platforms share far more sales data than their Western counterparts, allowing local brands to launch targeted products with surgical precision. And these platforms are built around brand, storefronts, and entertainment. Now get this. This hyper-competitive environment is forcing a massive strategic shift. Foreign companies aren't just localizing for China anymore. They're setting up R&D centers there to spot trends for the rest of the world. Between 2012 and 2021, R&D investment by major foreign firms in China nearly doubled. And while some have struggled, the comeback can be stunning. After losing market share, Apple's new iPhone 17 launch saw pre-orders on JD.com in the first minute surpass the entire first day volume of the previous year's model. But the ultimate endgame may go beyond data and price, driven by a powerful cultural shift called guoqiao, or national trend. Chinese consumers are increasingly favoring domestic brands that blend traditional culture with modern style, which explains why local jeweler Laopu Gold saw its revenue skyrocket 167% in 2024. This trend explains LVMH's strategy in Shanghai, opening a massive ship-shaped Louis Vuitton store as a nod to the city's history. It's a move to create a deep emotional connection. However, when we place these grand gestures alongside the company's recent performance, the contradiction becomes clear. In the third quarter of 2024, LVMH's sales in Asia, excluding Japan, actually dropped 16%. Another luxury giant, Kering, saw its Asia-Pacific revenue fall 22% in the first half of 2025. It shows just how challenging the market is. In the battle for China, the new rule is clear: adapt or be forgotten.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.